Hey, if you're studying for the SIE exam, you are in exactly the right place. We're about to crack the code on the three main types of investment companies. Getting these straight is absolutely essential for exam day, so let's make sure you walk away from this feeling like you've got it down cold.
So, you've probably seen these terms 100 times in your study material, right? Mutual funds, closed-end funds, and unit investment trusts. But when it comes down to it, what's the real testable difference? That's what we're here to do. Let's break it all down.
All right, here's our game plan. We're going to start with the absolute foundation. Then we'll meet each of the three players one by one, and we'll finish up with the ultimate comparison chart. The one you're going to want to screenshot for your study notes. Simple and straight to the point.
Okay, before we can even start comparing these things, we have to get on the same page. We need to start with the bedrock concept they all share. What exactly is an investment company?
It's actually pretty simple. An investment company is basically a vehicle for pooling money. Just think of it like a bunch of people putting their cash together to hire a professional, in this case, a portfolio manager, to go out and buy a whole basket of securities for them. The two key phrases you got to remember are pooling money and professional management. Now, here is a super critical point for the exam. Even though they have all these differences, all three of these funds fall under the same exact law, the Investment Company Act of 1940. It's a huge piece of legislation meant to protect investors, so for sure, remember that name. Okay, next up is the big one, the most common type you'll see out there, the mutual fund. If we can really understand this one, it gives us the perfect baseline to compare everything else against. Now listen up. If you remember only one single thing about mutual funds, make it this golden rule. You can't trade them all day long like a stock. Nope. Their price is set just once and only once at the end of the trading day. This one rule leads to two very important and very testable concepts. First up is the net asset value, or NAV. That's the price. The easiest way to think about it is like a pizza. The NAV is just the price per slice. So you take the total value of the whole pizza, that's all the fund's assets, subtract the cost of the box, which are the liabilities, and then you just divide by the number of slices, or shares. That number you get, that's the NAV. And that brings us to concept number 2, forward pricing. See, because the price is only calculated at the end of the day, if you put in an order to buy shares at, say, 11 a.m., you don't get the price from 11 a.m. You get the price that's calculated at the next market close. You're always buying based on a future price. The big takeaway here is you don't know your exact execution price when you place the order. Okay, a few other key features you gotta lock in. Mutual funds are always open for business. They're continuously creating new shares for buyers and cashing out sellers. They can be actively managed, where a manager is trying to beat the market, or passively managed, where they're just trying to track an index. And of course, they've got fees, like management fees and sales charges, which you'll often hear called loads. That's basically the commission. So, we've got the mutual fund rules down, right? Good. Now let's meet the rule breaker, the closed-end fund. This is where the really key differences for your exams start to pop up. And here it is, the single biggest difference. With a mutual fund, you're buying from and selling back to the fund company itself. But with a closed-end fund, well, you're trading shares with other investors out on an exchange, just like you would with a stock. The fund itself is not involved in those day-to-day trades at all. This whole structure leads to some other huge distinctions. Closed-end funds start out with a fixed number of shares from an IPO. And because they trade on an exchange, their price is bouncing around all day long. This also means their market price can actually be higher or lower than their NAV. We call that trading at a premium or a discount. And here's another big one for the exam. They are allowed to use leverage, that means borrowed money, to invest. All right, on to our third and final type, the Unit Investment Trust, or UIT. If a mutual fund is like a restaurant with a chef who's always changing the menu, a UIT is more like a TV dinner. It is the ultimate set-it-and-forget-it portfolio. The life of a UIT is super simple and, well, finite. A portfolio gets created, usually of stocks or bonds, and then it's locked in. That's it. There is zero active management. The trust just runs for a preset amount of time, and when it hits that termination date, the portfolio is sold off and the money gets paid out to the investors. End of story. So what's the big benefit of this structure? Well, since there's no active manager making trades all the time, the ongoing expenses for UIT
are typically much, much lower than for an actively managed mutual fund. That's a huge selling point. Okay, we've met all three players. Now for the grand finale. Let's pull this all together. This right here is the comparison you'll want to burn into your brain for exam day. Let's walk through this nice and slow. First up, shares. Mutual funds are continuous, right? Closed-end funds have a fixed number, and UITs have a fixed portfolio. Got it? Next, trading. Mutual funds and UITs are redeemed by the company, but closed-end funds trade on an exchange with other investors. Okay, pricing. Mutual funds and UITs use that once-a-day NAV, but closed-end funds, they have a market price that changes all day long. And finally, management. Mutual and closed-end funds can be active or passive, but a UIT is never actively managed. This table, my friends, is your key. All right, you've got the structures down pat. So let's end with one final question to really test your knowledge. Out of these three, which one is allowed to use leverage? Come on, think about it. It's the one that acts most like a company, trading out there on an exchange. See? This is a perfect example of why knowing these little differences truly matters for the exam.